Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, July 1st, and we are kicking off the third quarter with the big show coming to you from St. Augustine Beach, Florida. Expanded edition of the Revere Market Insight video where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world-famous 21 over 21 leaders list. Surprisingly, the 21-21 list held up very well this week despite a tough week on the indexes, and the market continues to be in a bear phase, and our trend following approach continues to get us out of the way for the most part. We'll review that shortly. So stay in the market in a correction. You can see over here at the trend gauge, leaders bearish / downtrend. Green arrow though, it's because they held up. As I said, the 21-21 list held up pretty well. Always looking for green shoots. That's a little bit of a positive, but you can see here in our 3 time frame trend gauge, both the short term, medium term, and long term are bearish or in a downtrend. What that means is that all 5 of the major indexes are trending below these moving averages. For short term, we use the 21-day exponential moving average, medium term, the 50-day simple moving average, long term, the 200 simple day moving average. As we're fond of saying, risk is very elevated when you're below the 200-day moving average. This is the area in the market where all of the, not just bear markets, but severe bear markets, they all take place when the moving averages are under the 200-day moving average. This is when we get extremely defensive, pick our spots for trying to get small gains and get the heck out of the way. We occasionally go short, which means we make money when the market goes down. We did that a little bit this week as we transitioned from a rally to a failed rally. We'll take a look at the tail of the tape and review that shortly. So what happened today? Third quarter started with nice pre-holiday gains. You can see green across the board here. G6, our in-house growth monitor. What it is 6 growth ETFs, and we keep a track of that. That will alert us to changes in trend. That was up 1.2%, S&P up 1.06, Nasdaq 100 lagged up 0.7, Dow Jones Industrial Average up 1.05, mid caps up 1.2, Russell 2000 up 1.16. Global diversified 60/40 stock and bond index up 0.72%. Our flagship portfolio, GROTECTION, up approximately 0.08%. We also had a dividend, our 10% position in VTIP, that's an inflation-protected short-term bond fund, went ex-div today. So that meant that the price gaps down by the amount of the dividend. The amount of the dividend was 68.5 cents. So gap down by 1.37%. That's equivalent annual yield of 5.47%. So that'll get paid out to clients next week. Reminder, this is why we hate the SPY. When they pay their dividend, they hold it for an entire month, which is unconscionable. But VTIP pays it out within a week. So that'll get posted to client accounts next week. We'll go through the tail of the tape, the updated 21 over 21 list. But first, we're going to go to the indexes. And before that, we're going to go to the team here at Revere. As I mentioned, trend following what we do. That means we participate in uptrends, and there really haven't been too many uptrends this year. The market topped right at the beginning of January. Down 20% for the year. We're down less than 8% across the board. So our trend following approach, where we participate in uptrends, tap the brakes when we start consolidating and going sideways, get the heck out of the way, and bearish trends primarily, and especially when we're under the 200-day moving average, which is where we spent the majority of the year. It's been paying off for us. It's the sleep at night factor that we offer clients that most advisors do not. If you're interested in this approach, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or you can call 855 Real Wealth. That's 855-732-5932. But if you call right away, we're having a special. You don't have to dial the last 3 letters of wealth. Just dial 855 Real WEA, and you'll get through to us. So enjoy that savings. All right, let's get to the tail of the tape and a chart of the S&P 500. Let's blow this up a little bit. Tail of the tape. So we continue to face the same headwinds that we've been facing all year. Strong dollar. Anybody that tells you that the dollar is going to toilet paper isn't paying attention to what's happening to currencies worldwide. The dollar is one of the stronger currencies. Oddly, the ruble is the strongest because with this sanctions, Russia found other places to sell their oil to that aren't paying attention to the sanctions, and they demanded to collect rubles, and that's oddly propping their currency up. But the dollar is well ahead of certainly the yen and the euro, which are the other major 2 currencies that make up the biggest components of the U.S. dollar index. But the U.S. dollar is at yearly highs. That's a problem for stocks. Inflation continues to be an issue, along with Fed tapering, balance sheet reduction, interest rates rising, although rates have come off a bit this week. This is something we're going to discuss a little bit later. And then, of course, we've got the overhanging Russia-Ukraine situation where we just keep shipping off billions of dollars into a black hole. But we're not going to get into a discussion on that. So sentiment-wise, put call not elevated, 0.97. VIX down 7% today, even with the market up 1%. That's a big drop for the VIX. The VIX really we've been keeping an eye for a big spike in the VIX that might signal some sort of a capitulation event in the markets. Not seeing it at all. That's a low number for the VIX considering where the indexes are. Fear and greed is at a 24, which is right on the border of extreme fear and fear. So bull case, we were in that for less than a week. We failed on 628. This week, our bear case went into effect when our rally failed and we broke through the short-term 21-day exponential moving average. So we're operating under the bear case right now. Some news for the day: ISM June manufacturing PMI was weak, signaling recession. What we were watching, levels we were watching coming into today: support for the S&P 500 at 3750, resistance on the upside 3800 to 3815, and then 3825 to 3830. So support held. We had a small gap down. We had a little bit of a move up, and then dropped down, and 3750 held, put in the lows. Then we trended up strongly for the rest of the day. First up to 3788, went sideways a little bit, then we broke out all the way up to 3830, flagged into the close. So late rally got us above this first resistance level, 3800 to 3815, and we stopped right at the second, 3825 to 3830. So these are going to be key areas for next week, is this 3800 area. And really the entire range, 3800 to 3830. So we'll take a look at that in a chart momentarily also. Also want to note TNX, that's the 10-year, 2 closes below its 50-day moving average, but it did put in a hammer. That means it sold off hard, closed the day strong. So mixed messages there on the 10-year. Something else that we'll be watching also. Strong today, bonds. Homeowners, home builders, extremely strong. ITB is the ETF for that, with interest rates dropping. IGV software had a good day, as well as utilities. Utilities typically perform well when interest rates are dropping. Terrible day for DBA. That's the food commodity ETF. Also, oil service stocks had a bad day. Fertilizers had a bad day. They usually move hand in hand with the DBA, and SOX, just an absolutely terrible day. Micron reported after hours yesterday. Not good news. Micron is a RAM play, but DRAM play, but it impacts the semiconductor index, and the SOX was down 3.5% today. NVIDIA down 4%. KLAC, that's a semiconductor equipment company down 7%. This just goes to show you that when you have a thesis, you hear it everywhere. Oh my God, we've got a semiconductor shortage for everything, TVs, appliances, vehicles. You'd think that semiconductors would be going through the roof, but they sure as hell aren't. Let's take a look at the stocks real quickly. And this is a case where when price action does not match your thesis, you got to default to the price action. I mean, this is down from 559 to 337. This is the semiconductor index. Terrible, terrible performance this year, despite the fact that there's a worldwide semiconductor shortage. So again, we default to price. Opinions don't mean a thing if price doesn't support it. And if your thesis is not being supported by price, you better change your thesis or wait until it is. Okay, so portfolio, no changes today. We're basically flat. We've got 5% gold and 10% in that VTIP short-term inflation protected bond ETF. We covered our short yesterday when we got down near the 37.50 support level. And then we started to bounce. We got back above 3,800. We took the rest of it off. And what we're really looking for another reentry on that would be a bounce, a move up closer to the 21-day moving average. That would fail, just the way I explained it in Tuesday's video as to why we flipped from long to short. And let's take a look at that right now. It's this area right here, bouncing off the bottom. Got back above the 21-day on Friday. That was 624. That's when we had our follow-through day. Monday, tight range. That's fine. Tuesday, we took off to the upside. Let's take a look at this. A 15-minute chart. Took off to the upside, everybody getting very excited, and boom, a very hard reversal put in. This basically killed the rally. Sideways on Wednesday, gap down on Thursday, but and then a bounce and a sell-off, and then another bit of a bounce. You can see this 37.50 area here providing some pretty decent support. We got up to this 38.30 area. Let's zoom out on this a little bit to a 30-minute chart. You can see 38.30 really being a battleground area here. We failed. We got gapped below it on June 13th and then failed to get back above it for the next 3 days. Another move down. Got back above it here with the follow-through day again on the 24th, or sorry, this was Thursday on the 24th. 25th was the real follow-through day, but then no, I got that backwards. The 24th was the follow-through day. That was last Friday. Gapped back above that 38.30, then tested it, broke back below it, tried to get back above it on Wednesday, on Thursday, and Friday. Got right up to the top of it. So very big area, this 38.30 to 37.50 area. This is the key area that we need to watch next week. There's 37.50-ish. If you want to take it a little bit lower, down to 3,800, but then on the upside, 38.30. So those are the key areas we want to keep an eye on for next week. So as I said, no changes to the portfolio. Let's bottom line this. Nice pre-holiday bounce off of 37.50 support, but we're below all the moving averages, as you can see here. Here's the 200-day, way above 12.9% above. If you pay attention to those bear market stats that I did in the interview with Richard Moglen, and also in the bear market webinar that I did, you save yourself on average 23% of additional downside. And in severe bear markets, even more. Right now, we're 12.5%, 12.9% back below that. After our initial exit back in January, a couple times we got back in this year, minimizing our losses each time, and all the way down here now, again, under the 200-day moving average. And then when you get below the 50 and below the 21, and they're all pointing down, that's just the market's not healthy. If you call your pie chart advisor, they're saying, we think the low is in. They said it here, they said it here, they said it here, they said it here, they said it the whole way down. Hey, we bounced. I think the worst is behind us. Terrible day, terrible week 3 weeks ago. Oh, no, we're bouncing. We're okay now. Follow through day. No, gave it all up. Discretion is the better part of valor when you're below all the moving averages, especially below the 200-day moving average. It's just the odds just aren't in your favor, and you're better off protecting capital until better days come. Got a plan for getting back in. We've exercised it 6 or 7 times this year. Each time it's failed. Minimal losses each time. As I said, down less than 8% on the year versus down 20% on the S&P. Nasdaq's down almost 30%. Small caps down in the mid-20s. Again, it's the sleep at night factor. So here's where we closed today, 38.25. Here's this level above there, 38.25 to 35. I pointed out that as resistance. Then below us, we've got that 30 down to the 3,800 area and really 38.50. If you want to go with some more short term, that's put the low in over the last couple of days. So there's your S&P 500 and the tail of the tape. Let's go to the Nasdaq 100, and then we'll get on to the 21 over 21 list. You can see here trending below all the moving averages. Dow Jones Industrial Average trending below all the moving averages. How about the mid caps? You think we're going to see a theme here? Yep, trending below all the moving averages. Again, fail into the declining 21. And IWM small cap trending below all 3 moving averages. So it's why our trend gauge shows what it shows. That's why we're maximizing defense and preserving capital. That's why we'll be able to compound capital from a much higher base when the market writes itself, and it will write itself at some point, and we'll be there ready to participate. And we'll be ready with stocks primarily that make up our watch list, our world famous 21 over 21 leaders list. Let's sort this by 3-month relative strength. Let's take a look at 3 that dropped off between last month. So last week and this week. So 3 stocks got punted. First one, FedEx. They've got the end factor, but it didn't hold it up this week. So gap up on earnings. They've got a new CEO. They've got new board members. They increased their dividend, but it still broke below the 200 and the 21-day moving average. We're going to keep an eye on this. I've got an alert there if we get back above the 21. It's got a PEG ratio of 1, which is fantastic. So PE of 11, growth rate of 11. It's very fairly priced. We don't really focus on that normally, but when you are when you're in an environment where growth stocks are not outperforming, you got to look for other ponds to fish in. For a while it was energy broke down. For a while it was commodities, those broke down. But stocks like FedEx can get on a very nice run if the market decides that that's where the money wants to go to. And but for now, we're cutting it off the 21 over 21 list. Another one that we cut off, Path. This was something that showed some relative strength coming off the bottom, but had a rough week. So cutting that one off. Also cutting off Ulta, which had another one with a great earnings report. Sold off here in sympathy with what was going on with Walmart and Target back when they warned, but a big gap up on earnings. But this is a bear market. This is what happens. You sell strength in a bear market. No follow through, and now breaking below the 21-day moving average, so getting punted off the list. So the 3 that were added this week. Bear with me for a second. Okay, the first one added AutoZone. Don't like the fact that it's a $2,160 stock. Hey, AutoZone, split your stock. If Amazon and Google can do it and Tesla can do it, you can do it. But the reason we don't like this is because you get a rounding error in accounts. But whatever, it's on the 21 over 21 list, which is identifying leaders. So look at the relative strength over the last 6 weeks here, forming a tight pattern. It's a cup and handle. Now, I just got finished saying that you don't buy strength in bear markets. Why are we keeping this list if it's a list of strong stocks? Well, they can pull back into moving averages and lighten volume, still show relative strength, and be a great risk-reward entry if the market has a follow-through day and wants to continue to the upside. again, PEG ratio under 1, PE of 20, we're growing this year at 24%. So it certainly meets the growth characteristics, and stocks that hold up in a bear market very frequently lead the next bull market. So that's why we keep this list fresh. UTHR, another one added. This really shouldn't have been cut off last week. I think it was a mistake that I dropped it, but putting in a nice flag after some really excellent volume patterns. This is one that, but again, broke out and really hasn't made any progress, but is still showing relative strength. And Celsius added as the third one, can't get above the stubborn or stay above the stubborn 200-day moving average, but it definitely has the growth numbers to support the price action, and showing some relative strength. Not as much as some of the other stocks we've been showing, but 3-month relative strength is at a 96. Excuse me. So now to the 18 that survived from last week. PDD. This is a China stock. Third-party retail internet mobile platform for it's kind of the equivalent of a Shopify, showing relative strength. Keep in mind, I don't like buying China stocks, but the Chinese central bank is easing policy while the rest of the world is tightening. That's why China stocks have been outperforming lately. Again, reasonably valued. It's on the list. Monster Beverage continues to show relative strength. RS line at a new high as it carves this double bottom base. CNC, the managed healthcare and really healthcare in general has shown some serious relative strength over the last couple of weeks. When you see this blue ball here, that means relative strength at a new high, forming a double bottom base. Centene, United Healthcare also looks good. Merck, drug company, you did see some pulling back this week after these things got extremely extended. You're seeing the relative strength there, but even with it pulling back, you can see relative strength held strong, bounced right off the 21 where we need it to. DG, Dollar General, flagging after a breakout from this cup and handle base. Relative strength is there. BJ's, kind of a similar theme. Discount retail. In times of a trying economy, people trying to maximize their value in these price clubs really attract buyers at this point. We were in a jam-packed Costco last weekend. So pulling back to the 21 as part of this double bottom base. GTLP, Computer Tech Services, nice relative strength, showing just holding up very nicely here. Look at the trend of what the S&P is doing. That's the black line up here. GTLB going sideways during this period. Now this relative strength line is a 30. That's the year-long relative strength. I don't pay attention to that. I'm more concerned with this 96 3-month relative strength because we all see that it dropped here while tech stocks were getting slammed at the end of last year and the beginning of this year, but it stopped going down. It's collecting itself, forming this kind of really nice tight base. PWR, after a tough week the last couple of weeks ago, reclaiming the 21. It's a building heavy construction industry stock. Chewy, insider buying, good reaction since its last earnings report, back above its 50 and it's 21. I see this declining 200-day moving average, but there will be some stocks that come back after severe sell-offs. And really what we begin to look for is things where the stock is not making a new low while the indexes are making new lows. And Chewy certainly fits the bill there. That's what's going to impact this 3-month relative strength. And they've got the sales numbers, not necessarily the earnings numbers, but the pattern does look pretty good. Shockwave, really like the look of this one. Medical equipment and medical systems and equipment company. If I could talk, you'd know that. Broken cup with handle that didn't pan out, but showing some relative strength along with medical stocks over the last couple of weeks. Up at this 200 area, putting in a low volume flag here. 47% earnings growth next week, although the PE, or next year, although the PE is pretty high. Northrop Grumman, good week. One of the things that came out of the G7 meeting this week was that a bunch of European countries committed to increase their defense budgets. In response to what happened with Russia and Ukraine, you can see two nice price days, one with big volume on Northrop Grumman off of this power of three is what you call when we've got the 21, the 50, and the 8 all bunched up there, and we move up off it and look at the relative strength. Really going back to April in these, this is something you don't notice without this relative strength line on your charts. The price action just going sideways, while the black line, the market, pulling back. The relative strength going from Arizona up to Maine, while we're just going sideways. So this is what we look for. American Tower, this is a REIT, but they're not a real REIT. They lease out space to cell phone companies. Relative strength at a new high. When this thing moves, it does move quickly. Vertex, one of the leading medical biotech companies, nice move up along with the rest of the medicals. You can see the relative strength there, and then just flagging this week as the market pulled back. T-Mobile, really the only one of the big providers that's growing. You can see the relative strength with the growth line there. Cup and handle failed, came back, bounced off the 200-day, then reasserted its relative strength. Eli Lilly, same pattern on medical, but hardly any pullback on this week, despite the market sell-off. And look how the relative strength continues to really look fantastic. Enphase, very choppy action, hit and miss action with the solar stocks lately, but this is a leader. Holding this 21-day moving average, bounce down this 50-day and 200-day moving average area. And finally, Zoom. You know, Zoom's been on here for a while. We're going to go out to the 30-minute chart. They had a nice earnings reaction, going sideways, tried to break out. Harsh pullback here, and certainly a tough day on Thursday, but it recovered some of it. And the numbers were there, the good reaction since earnings, and it did hold on to the 21 this week despite having a tough overall week. And last but not least, AT&T dividend play, showing relative strength, not a grower. You can see even sales growth declining over the last 3 quarters, but that dividend is pretty nice, paying a 5.2% dividend. Probably not something I would ever end up buying, because of situations like this. Oh, it's holding up great, and then it drops from 21.50 to 18.67 in the course of 2 weeks. That's a pretty big, more than 10% pullback for a quote-unquote safe stock. But it did reclaim it, and keeping things like this on the list reminds us of where the strength is. Sometimes when that strength is in extremely defensive stocks, that's telling us something about the market. It's a watch list. It's not necessarily a buy list. And that's going to wrap it. As always, like to hear from you. Oh, I do want to take a look at the 10-year bond I mentioned here, 0TNX. So this broke out 3 weeks ago. It's pulled back in, initially bounced off the 50-day, but now 3 days down, 2 closes below the 50-day, but it did hammer. This is when something shakes out early in the day and closes at the top of its range. Looks like a hammer. That's probably why they call it a hammer. We're going to keep an eye on this. We were in TBT, which is the inverse of the price of bonds, so it goes up along with rates. We sold it up here with this gap up. It just seemed exhaustive. Had this big outside negative reversal day on the 16th, and then it has pulled back, bounced off the 50. Now again, 2 closes below the 50, but with a hammer. It's 25 area. Provides a lot of support if you look to the left side of the chart here. So it's going to be interesting to see how this plays out over the next couple of weeks. Let's go to TLT, which is, this is the price. So this is the inverse of what the yield is, and you can see the price going higher. Now, you've been hearing a lot about, well, primarily from us, but the death of the 60-40 portfolio, because bonds have just been garbage this year. Bonds are supposed to hold up your portfolio while stocks take a breather. They certainly haven't done that at all this year. That's why we trend follow. It's like saying you want a well-balanced diet, but you go to the grocery store and all the vegetables are rotten. Are you still going to buy them just so that you can say you have a well-balanced diet? No, you don't diversify into downtrending assets. So that's why we've avoided bonds, except for really inverse bonds by being in TBT and making a little bit of money taking advantage of the rising interest rates. But bonds trying to put in a bottom here. We'll see what happens next week, and that will wrap it. As always, love to hear feedback from you. You can email me, don@revereasset.com, or phone 855-REAL-WEALTH. Wrapping up the first day of the third quarter, 7-1. Hope you have a great extended holiday weekend. Stay safe, everybody. This is Don Vandenbord reminding you it's not how much you make, it's how much you keep. That's why we focus on protecting our clients' downside, and then the upside takes care of itself during market rallies. And you compound from a much higher capital base than if you got smacked for minus 20, minus 30, minus 40 or more percent. And this is where risk picks up when the market is under the 200-day moving average. Have any questions? Email me, don@revereasset.com. Just the facts here. Don't shoot the messenger. Thanks for listening. Have a great weekend.